It's been over 3 weeks since their Bitcoin ETF announcement, and Bitcoin has failed to reach a new fresh high. It has also been smashed down 13% now, at its most extreme 21%. And sellers, investors continue to smash down the price in volume like they have done in the bear market of 2022. But there is a silver lining to all of this. It is the macro bull market, and they are trying their hardest to smash the price down. And I'll show you that specifically using the facts from the charts. And of course, like I said, the good news to this, the good news is the price has not been crushed like it has done in the bear market. So let's get into that. Plus, I have got so much data for you. Probably one of the biggest data-filled videos that I've done in a very long time. So don't go anywhere. Hit the like and subscribe button. We're going to cover everything today. Your holistic view of the investment markets, stocks, the indices, the real estate cycle, Bitcoin, and where we are currently at in this cryptocurrency bull market, the overall cycle itself. So thanks again to all of the birthday wishes from last week's video. Much love to you guys as well. Getting headfirst into Bitcoin right now as the market is struggling to maintain $42,000. Then we'll go into the macro, looking at that real estate cycle to update us with all of that data throughout the entire financial markets. Okay, so where is this coming from? I made huge statements in the intro looking at some of the biggest selling we have seen since the bear market. Now, the chart doesn't lie. We can see there are huge volumes of selling coming in. This is selling at the bottom, and if you see this bar nice and high, tall, it means there is a lot of volume coming into the market. And then if you see the bar, or if you love candles, you see red and it's down with low closes, you can tell that that is a lot of selling coming into the market. So then we just compare that to what has come previously. We see big selling on the way up, where we've followed through with the Wyckoff schematic, looking at this being the distribution and the confirmation of distribution. Essentially, those sellers came in and pushed the market price down from the peak to the trough of 21%. So the market has bounced back relatively well. We're not there yet. And this particular line here, at the top of the 12th of January, is basically where I want to see Bitcoin get to and consolidate above in order to clear out the change in behavior. This is something that we learned from Wyckoff. So you've got change of character, change of behavior, same thing, called basically two slightly different things. Essentially, this just means that you can see the change of behavior in the market come through based on the volume and the price bar. The market was running up after a very long time. We've covered that. It's been roughly 122 days into that peak. And then you start to see a change of behavior from the investors and the traders, where you start to see heavier volume come in as the market pushes down. And you hadn't seen that previously on the way up. You saw big volume pushing the market up. Then it starts to shift, or it starts to tilt that way, I should say. And you see more selling coming into the market, and the price is unable to really fetch higher and higher prices from that point. And so that's why I've got that line drawn here at roughly 46,500. Now, of course, we have several other levels to get through. First, as we pointed out last week, 43,800, which is the 50% level. The GAN 50% level, rules that have been tested over the course of time, over 100 years, not stuff that is just made up. This stuff has stood the test of time. As you can see, it's been rejected a couple of times at 50% to the upside, and it's trying to find support at the major 50% level of the entire range here, bear market low to the bull market top, and that is at 42,200. So Bitcoin is having some troubles gaining the ground, but it's not failing to the downside as bad as it had done during the bear market. So although we have been short-term bearish leading into this halving, where we expect things to turn around and continue up for the rest of the cycle, we can see that the longer trend is in a macro bull market. So we're not fearful that this market is going to come down and take out 30K. I've talked about that so many times. I'm still looking at roughly mid to high 30s for the final correction, if we haven't already seen that final correction at 38,500. So the selling since the collapse, the FTX collapse, the Luna collapse, the DeFi and CeFi collapses of 2022, you can see that this bar that changed the behavior of the market structure to the upside has been the highest volume since that period, the highest down bar volume. So we can expand this out. You can see going all the way back to the FTX collapse and where it finally found the price cycle low, 15,460. That was the highest selling pressure near those lows. You can see that it changed the market behavior. We're still sitting around those prices at this point. So maybe time just needs to catch up here where we just trend sideways, trend higher, somewhere around these prices, maybe come back to test the lows. There is no guarantee of that. But essentially, this sell-off is nowhere near as severe, of course, as anything previous because we're in a macro bull market. So how do we use that information for our own trading and investing? Essentially, the way I look at it, don't get greedy to the downside. I'm not expecting $30,000, $32,000 levels, which means then I'm not expecting anything underneath those levels either. And whatever the market gives me at roughly those prices, mid to high 30s, that is what I will take. Now, when is this invalidated or when does the trend change? I would say once we first get back above 43,800 because that's the 50% level, and finally above 46,500 because that's where the change in behavior occurred from. So they're my price targets to the downside. Looking at that mid to high 30s, potentially we have seen it there. I suspect maybe we'll have one more attempt because we still have a fair bit of time to go in terms of the cycle itself, and I'll get to that in a moment as well. And then to the upside, should the market not come back or basically invalidate where we currently sit, then I'm looking at those two targets, $43,800 and $46,500. Now, over to the macro cycle, some of the massive data that I've got here for you guys. There is a lot to get through, so stick with us. Get your favorite beverage. I've got a cold brew with me this morning. Let's crack on with the next stage. And I'm very happy this morning to see that Elliot from Elio Trades has been promoting the 18.6-year cycle to over 600,000 people. So hopefully more people can be exposed to what's going on in the macro cycle, what governs all of the financial cycles themselves through the stock markets, real estate, and of course, the more degenerate stuff that we love, the altcoins and the Bitcoin, because essentially as time runs out to this peak, roughly around 2025, 2026, remember, this is for the real estate and economic cycle around that peak, and then potentially the stocks go a little bit further into late 2026, maybe 2027. Eventually, everything rolls over. Now, that does not mean that Bitcoin and cryptos will run up into 2026. They may, but it doesn't mean that everything has to run up at exactly the same time. If we've looked at previous cycles, you can note that each of these assets have slightly different timings. From the previous cycle that we went through in 2006 into that bottom in 2009 to 2012, you can see that real estate topped first, the stock market topped in late 2007, gold had a top in 2008, corrected and then pushed on to 2011, and of course Bitcoin and crypto really wasn't around at that point. It came about in 2009, 2010. So they all had different peaks, but the cycles all come together and everything starts to roll over around that point. It's a big cycle, 18, 19-year cycle. So you are going to see things take a lot longer to play out than what we do in crypto. So there is plenty of noise out there telling us that we may or in fact should see a recession in 2024. It is an election year. It's probably unlikely that it does happen just based on the data as well. But simply what you can do now, bring up a chart and look at how these markets are progressing. This is the Home Builders ETF. It has run into a new all-time high in late 2020 after the COVID bottom, after COVID crash and bottomed. It ran up into a new high. It's pulled back into a, higher low. Yes, you can see it right there, a nice big higher low, and has now run up into a new all-time high again. Now, there is old sayings, when these markets run up into new all-time highs, there's no knowing how far they'll go. So trying to call a recession throughout new all-time highs is basically like playing with fire. Saying that markets are going to crash and collapse every step of the way is really going to get a lot of people burnt. Now, there is several pieces of data that would suggest that markets do have to collapse. And there is plenty of people putting it out there. I can show you lots and lots of different things, nothing against the people, just the particular pieces of data and how we use them. Everyone's entitled to their own opinions, of course. But for me, the way I see a lot of the stuff where it's always collapse, 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 and the fact that the markets are going up when you just pull up the facts from a chart shows me that maybe the way the data is getting used by the analysts themselves is that it's like pulling all different pieces from everywhere and trying to put a puzzle together. They don't have a picture of what the actual puzzle is, and they're basically just pulling different puzzle pieces from everywhere, trying to mash the thing together. It's probably not going to work, and it hasn't worked out this entire time while the markets have been climbing just based on the facts from the charts. This is just the home builders ETF in the US. You can go to the biggest home builder in the US. Also, new all-time highs. You can see the peak of the real estate cycle before the collapse, and then the markets have gained from that point again. You can go to the US Case-Shiller Home Price Index. Prices have been up since those cycle bottoms. And yes, COVID was a huge, huge pump to the upside. We've had the correction, and now we've had 9 straight months up with 1 pullback. Remember, markets do have to have corrections, and they must have pullbacks like it has done all the way up into those previous peaks as well. Now, we're not going to stop hearing about recessions, and I think this one is probably one of the best examples of recessions being called at the exact wrong times. Now, recession alerts. This is not blood in the streets yet. They're waiting for blood in the streets. Look at the date here. Not by a long shot. Maybe some are willing, but no blood. It's a stretch to assume that we're at a major bear market bottom, and it's rid itself of all the weak hands. This is what everyone believed. October 12th, 2022 was the day before the exact low. Now, I don't know about you. I would be very much happy buying at a day before the exact low of a market, looking at where it's come from to where it is now. I think it's somewhere around the vicinity of 40%. There you go, nearly 40% to a T. So about 39% from that particular tweet. So this is why it's really important not to get swept up in recession calls and potential prices crashing and plunging every step of the way, because it's more likely that markets are going to go up over the long haul. And if you've already seen a very significant sell-off like 2022, the chances that you'll see that again so soon are very unlikely. Not impossible, but very, very unlikely. And what we want to do is put the probabilities on our side, because these may be the, if I get the right one up here, the final times that we see very, very fast movements to the upside and get those gains, those 25x cryptos and Bitcoin gains, before we see a multi-year bear market. Now, after these peaks, I'm expecting a multi-year bear market. I think these moves to the upside are the symptoms of that multi-year bear market coming. And basically, you can see everyone's sort of getting into this rushed phase of trying to get in before they think the markets are never going to come back. And at that point, that's when the markets typically do pull back, and they're pretty severe. So we're going to keep watching that real estate cycle and, of course, the stock markets and Bitcoin and crypto for these upsides. So let's get into some more data. Now, some quick fire data. We've got things looking at manufacturing. We've got things looking at the household cash levels. Also, layoffs as well. So all the questions that everyone has saying, well, this isn't looking good, this isn't looking good, this isn't. Remember, Bitcoin and cryptos need the rest of the market to be going up in order for that degenerate money to come over, basically the higher risk to come into Bitcoin and cryptos to keep pushing up these markets. Markets meaning, in this case, altcoins. So you want to see more money, more risk appetite coming into the financial markets to then boost these things up at the very end. Manufacturing, from our good friend here, Seth. What getting close to a recession does not look like. ISM manufacturing orders, highest levels in 17 months. Manufacturing orders are up. Next, households have 18 trillion in cash, up from 13 trillion pre-COVID. Apparently 18 trillion in cash and 5 trillion more than COVID. We need another tax relief. It's an election year. Yes, they keep putting more and more money into this system one way or another, even if it's not in the face of pure just money printing. We've seen it from banks allowing their customers, whether it's the US, UK, and Australia, we've seen it across the board, the deposits have started to come down. You don't need as much money to deposit into the market in order to get your loan. Therefore, it's easier to get more money. When you get more money, money is more free, and then they start to go and flog it into the markets because they start to see prices go up. That's just one way the banks are doing it. the way the governments are doing it, they start to reduce taxes. They pull different schemes off the table and start to take it from other places. We see land taxes going up, but we see some of the stamp duties and taxes to get into properties coming down. So one way they take it from you at the beginning, but they slam it with you later on down the track. These are the sort of things you start to see towards the end of the cycle because they want more and more people getting into the markets to keep pushing these prices up. And of course, it's an election year. So of course, they want to see the economy do as best as it possibly can. Next is the layoffs. And Seth's got a really good point here. Looking at the announcements, even though they fail to capture the overall trend, layoffs are actually still below the level prior to COVID and trending downwards. So we can see this is all trending downwards. And what they tend to do when they like to pull different sort of numbers here and there, not just picking on one person here, unfortunately, but you get the idea, is that when they see some of the numbers come up for a month or two, that's when they get really excited. But we want to look at longer term trends. You know, we love to look at things that are 20, 40, 60-year type of trends to get a better overall picture of the market, not just the few months. A few months are always going to skew the results and tell you to go one way than the other. It's like those influencers online that say, buy this day, sell the next day, buy this day, sell the next day because the market's going up and down. That's the stuff that screws people. Now, this is phenomenal. Now, we've got some stuff on January and what happens throughout the rest of the year, but I don't want to get too bullish because there is going to be ups and downs throughout the year and potentially what we may see in February or March. I'll get to that in just a moment. But essentially this, January is in the books, keep it at 100%. When January delivers a positive return in an election year, the rest of the year has always delivered positive returns. Of course, it's 100%. One time it's going to fail eventually. Hopefully it's not this year. I just got to keep that real for us because there is no 100% guarantees. Eventually, when you get enough data points, eventually one will fail. Is it this time? I don't think so. I think there will be one in the future, but now doesn't seem like the time because we're looking at this overall cycle. Now, if it is next time, that would be a much better reason why it could fail if we're going through that collapse. So the data itself, January S&P returns, 2024, we got 1.6%. So these were all positive years. And basically the rest of the year has been pretty significant. You can see that somewhere around that sort of 10-ish% with a big return here at 20 and also 17% returns. Now, this one here is the big one for the markets, everything going up. And basically 74% of the calendar years since 1926. So that does include the years running up into the big peak in 1929, and it also includes the Great Depression years and the Second World War years. So lots and lots of negativity in the world and downside, as you can see from 1941, 1940, you've got 1929, and also some big losses. I think it was around 1930, 1932. You get the idea. It was a Great Depression. What this is saying is the least probable annual return is a decline of greater than negative 20%. Basically, it's unlikely that you would see a negative 10 to 20% per year. The most likely you would see is a year greater than 20%. Then the next most likely is a positive return of 10 to 20%. So if you start to pull these together, that gives you 60% chance of the market doing 10% or more. Group this in with a 0%, that brings you up to a 74%, as the data suggests here. 74% of the time, the S&P is going to go up, and this data goes back 96 years. So it seems like it's all working out relatively well for this stage of the cycle. 74% of the time, 3 out of 4 years, markets are positive. 1 of those 4 years, they are negative. Now, there is so much more data to get through, but I'm going to save that for future videos. So make sure you hit that like and subscribe button. I do have a couple more pieces to get through before we get to cryptocurrencies. And this is just putting a little bit of a realistic perspective on the market leading into 2024. So we can get an idea of these cycles for Bitcoin and cryptos as well, of maybe how we could see some pullbacks or continued pullbacks in the case of some altcoins. Now, February is usually weak, especially in an election year. So we're looking at these ones here, the dark blue, and you can see where these dark blues line up with each corresponding month of the year. So that's the election year. Green is past 10, and then since 1950 is the gold. So February, what we're currently in, typically not such a good month no matter which data point you are looking at. And you also don't get a pretty good return in September. October also quite negative for the election year, which isn't really a surprise considering you have the election in November and then you get this big pump in November. Now we've seen that multiple times in the market. We can go back to 2020 when we had the election. There is September, there is October, and then you get November, nice big pump out. Go back to 2016 when it was the Trump election with Hillary Clinton. 2016, you've got your down months, September, October, come the November, come the election in November, boom, pump from that point. So yes, that's two of them. I don't need to go through too many more data points with you guys. You get the picture. Essentially, February could be that pullback, have a little bit of a move up, maybe more of a move up, and basically nothing in May, a little bit in June, July, August, pullback September, October, here comes November. So as you start to put this little bit of a graph together, you can see that it's not, well, potentially not going to be a straight line up for 2024, but come the end of the year, maybe we're going to see that movement. And that's what essentially we're looking at. The first sort of 6-ish months of the year, the first half to make it easy, we're looking at the possibility of some volatility. You can see some down months here, February potentially, that one. We've still got another 3-4 weeks to go. And from that point, then things should get a little bit clearer in Q4 of this year, which also lines up with, well, our Bitcoin and cryptocurrencies. So here is the total cryptocurrency market cap using our TIA indicator here. And what I can do is turn off Bitcoin, ETH, and the stable coins to give us a clear picture of the total cryptocurrency market cap. Basically all of the degenerate coins out there and what their price movements are doing. So looking at these timings and basically what we just looked at with the election year and the possibility of a big pump up in the end, for the total cryptocurrency market cap, total altcoin market cap, let's call it, you can see we've gone through this schematic here. It looks like we've broken out into phase D, and we're basically trying to consolidate to get back into that phase E. So in terms of timings, low to the pullback, you can see from the cycle prior, you got the pullback and then into that halving. Essentially, we're lining up pretty well right now, lining up with that timing. The low, 14 months up, you can see here 14 months to that peak, and then pullback. Obviously, it's not going to be a pandemic pullback. I hope that is clear enough for the majority of people to understand now. I still get some comments like that, but essentially, pullback, we're just looking at the flow of the market here, and then the market essentially starts to run up from that sort of halving or a month or so before or after that period. So this time around, we haven't had such big fluctuations like we did in the prior cycle, which may mean we only pull back into this zone of about 280 to about 320 billion. Currently sitting at around 350, so there may be a little more downside, but nothing so severe compared to what we had in the previous cycle. So if you're waiting for those 20x, 50x, 100x altcoins, now is that time. And yes, I continue to put out content like this because I think this is going to be your best time considering where we sit in the market. If you weren't bagging up cryptos at these particular lows, I think now is probably one of the safer opportunities because the market is showing it's broken out of previous resistance and potentially will come back to sit or close to that particular support. Then give it to the end of the year when we get that election running. As you can see here, November 2020, markets go ballistic from that point. And essentially from that point, roughly about 12 months, not from now, but from that period roughly around the election in 2024, you've got about 12 months to go for the crazy bull market, which then lines up relatively well. This peak here is about 2025 to early 2026 for real estate, for the real estate cycle. Remember at this peak, that sort of lines up with where that crypto could get to before you start to see crypto sell off and some of those profits go into real estate and stock markets and other things like that. So everything is still on track with the cycle. If you want to stay up to date further with a fresh TIA crypto and economic report to your email, go check out the link in the top of the video description right there. Subscribe to that, and you'll also get updates with any deals that we have coming up for TIA Premium as well. We went through a ton of data in today's video, but I have plenty more coming up for you. So don't go anywhere. The cycle is still on track. Hit the like and subscribe button down below if you are new and you enjoyed what you are seeing. I'll see you back here at the next video. So until then, take care and peace out.